kind of everything startups. You're more than welcome to ask questions or propose topics around anything startups. We're happy to dig deep in that area as well. So I guess to start, Nick, I'll let you introduce yourself first and then I'll jump in.
Okay. I thought I needed no introduction. I thought that's what you were going to say, Cole. Hey, everybody. I'm Nick Longo. I'm the co-founder of Geekdom, and I'm also the founder of Coffee Cup Software, which was a bootstrap software company that I started in 1996. Ultimately ended up selling and exiting. But I started that company with no funding from VC or angels. So we can talk a little bit about how I got there and how that happened versus what's happening today and what it means on that side of it as well. And a lot of the things that we do around Geekdom and how these things mesh together. So now it's up to you, Cole.
All right, so I'll introduce myself. I am Cole Wollak. I am director of RealCo. RealCo is a startup accelerator where we help founders grow their companies to 500K in revenue a year. And that's the graduation point for a lot of our companies in the program. The program is a long-term program. We work with companies over a 24-month period rather than a typical 3-month period in the accelerator. And we are working with founders who are typically raising capital. So have a lot of experience with founders raising capital, helping them raise capital, structuring around pitches, all that. Same with Nick. Also has some experience working with the Geekdom Fund here in San Antonio, which is a traditional venture capital fund, watching probably hundreds of investment pitches. So I know what looks good and what looks bad and what can attract capital. But more importantly, I think today me and Nick want to touch on when's the right time to either be bootstrapping or thinking about fundraising, I think is most important today. So that's a little background on RealCo as well as myself. But I guess to start, we'll do some introductions on the bootstrapping model and the fundraising model just to lay some foundation, and then we'll jump into some questions if you guys have them. If not, I can ask a few questions to Nick.
Sure. Well, I'll ask questions of you too. And don't forget, guys, on that live chat side down there, hit that chat button and ask us questions, please. Make comments or whatever, and then we can kind of play off of that. All right. So when we talk about Bootstrap, what we're talking about is using my own money, right? Which is some money I may have saved, or it may be from my credit card and max it out. I can tell you a story about that. Or taking out a loan or asking friends and family. The difference is that I'm not going to be asking for them to take any equity share in the company, right? I'm going to either use my money or I'm going to borrow that money at an interest rate that I'm paying them back directly, or I'm just accepting that money as a, hey, thanks for the gift. You're an awesome cousin. But it is primarily based on the fact that my business will be driven by customers, and my customers will be my number one investors. So going into my software company, that is exactly how I approached it. I did a really low amount on a credit card and started building customers one at a time until they were actually funding my next hire, the next piece of software, and then carried that on for 11 years without taking any venture capital funding or any angel funding throughout that process. Now, that almost sounds like there's some hero thing in that, like I didn't take the money, but let me tell you that there was also a hindrance to that, was the fact that it also will slow growth. And I'm going to let Cole jump in from there on why money is adding gasoline to your fire versus doing it the long way, which is what I did.
Sure. So I'll touch a little bit on the fundraising and motivations to seek fundraising, and also touch on some of the sources, I guess. So first I'll touch on the sources. So a lot of times the first kind of formal investment round after, say, if you raise some capital from friends and family, will be what's called an angel round. A lot of times these are individuals who have made enough money that they want to invest in other entrepreneurs to have them grow their business or startup. It's important to know what the motivation is for a lot of these angel investors. There's usually two. One is monetary. They want to invest their capital to have it grow and return more capital. But other, probably most importantly for angels, is they want, a lot of times are investing because they want to further their impact beyond the capital. Your company might be doing something in an industry that they had participated in and they want to see change in that industry. It might be an impact to the future, the world, how we live, how we work, and they want to be a part of that. It could be a lot of different motivations, but pro tip, just ask why that investor is interested in, evaluating opportunities for them to invest in, so you understand their motivations and you can speak to that. The second group that's probably more well known would be venture capital. What to know about once you get to venture capital is the bar moves up dramatically as to what metrics, the progress you've made to date. The bar is a lot higher to successfully get venture funded. And so you want to know when's the right time to approach venture. A lot of times, a lot of funds will state it on their website, or you can just reach out and talk to them about it, or look at other investments they've made and talk to those founders to understand what's the right time to reach out to that fund. Every fund typically has a thesis. They're investing in an industry, a category, a business model. Some are general that invest across the board, but if they are specific, make sure that you fit their thesis. Otherwise, you might never hear back, or you're certainly going to get a no and you're probably wasting your time. So with VC, make sure you align with both the stage you're supposed to be at, the progress you've made to date aligns with what they look for, as well as the industry or business models that they're investing in. Lastly, I'll touch on government grants, which is a non-dilutive form of raising capital. Sounds awesome, but there's pros and cons to it. One is it can be a distraction. It's very slow money. You won't apply and get funded tomorrow. Usually it takes weeks, if not months, to go through a government grant funding process once you apply to get capital in the bank, if you are accepted. But to share what's typically seems like best fit for government grant funding is a highly technical challenge or hurdle that needs to be overcome is generally a very good fit for government grant funding. Because they're okay betting on very risky stuff that needs further development before it can reach commercialization. Though I will say today, a lot of government grants are very focused on commercialization, so you can't just ignore the commercialization aspect and just nerd out on the technology. You have to have a piece of that commercialization well thought out before you apply to a lot of government grants today. I'll throw it back to you, Nick.
Yeah.
And maybe a formal question. Why did you decide to bootstrap?
I decided to bootstrap because I don't think anybody would have actually given us money. That's one. Because we were so relatively new at the time that it would have been more difficult for me to spend time, which is extremely valuable for a founder, to go out and look for investment. And so it's choosing how much your time is worth to what you can build the company to, versus let me go out and spend X amount of time, which could be half of my time or a third of my time raising. And we see that a lot with RealCo, where determining how much time you want to spend on this versus how much you should be bootstrapping and getting customers instead is a very fine balance. It leaned more for the bootstrapping for me because it was more of a necessity thing. Different years too, to be honest. We talk about that a lot, but I started my software company in 1996. We didn't have the opportunity for VC. We didn't have the opportunity for angels. We had the opportunity for VC. VC came to us a couple of years into it though, which then I declined because I was already, very profitable. So it would have made sense. But angels in themselves, not that they're relatively new, but the coalescing, the putting them in big circles, that is relatively new. And saying, hey, I'm an angel investor now is actually relatively new. So it's a fantastic opportunity though, because adding the fuel to the fire of what you're creating, coming from angels who have a tendency to be more, I don't want to say freewheeling, but they absolutely have more give and take in what they invest in. I've always made them, if I have to make them akin to something, guys, I make them akin to being a stock buyer. And then I make venture capitalists tend to be more mutual fund buyers. So you put money into a venture capital fund as some wealthy person, and you trust the fund like you would a mutual fund manager to go and make the right investments for you. You're not going to be looking at them yourselves likely. And if you do, it'll just be a pass by and say, oh, wow, these guys are doing great. On the other side of that, angel investors are a little bit more proactive. They're looking for specific things. They're looking for basically stock picks and stuff. So hitting up angels early is pretty smart, especially if you're doing something new, because they're more likely to look at that opportunity the same way you're looking at it. And it doesn't fit within a venture capital firm, if any of that just made sense for you. I was going to ask you that same question. Tell me the difference between venture capital and angel.
For sure. We had a question come in. You want to address that one?
Yeah.
Let me take it first on the funding side, and I'll throw it to you for the bootstrapping side.
Yeah.
So the question was, have you seen any changes since the pandemic? I'll share on the venture capital side. We saw a lot of firms right when things first hit really close down external investing and focus internally on their current portfolios, supporting their current companies. And there was a real slowdown in kind of new activity of new investments. We've kind of gotten out of that phase, and I see a lot more interaction of venture capital firms reaching out to companies. I kind of feel like we're back to the same activity, but not in the same ways. A lot of meetings are happening over Zoom. A lot of things are starting remote versus in person, which I think can actually be a strength for a lot of companies that might not be in an epicenter of a highly dense kind of metro area that has VC firms in them. You probably have an easier time now getting in front of venture funds that aren't in your geographic location. So it's pros and cons of both, but I think you might actually have an advantage today if you're not located in a highly dense area that has a bunch of venture capital funds around you. So have seen changes, but I will say I feel like we're back to normal, which I'll circle back to another topic. But Nick, I want to ask you about the same question. Have you seen any changes since the pandemic? I want to extend it a bit further on bootstrapping. How should I be thinking right now? Like what, maybe I did get hit by the pandemic, maybe I didn't. Like what are you seeing with different types of companies, and how should they be thinking right now, say if they are bootstrapping today?
So some numbers just came out recently that there has been an increase in business formations. There's been a 40% increase, and that basically means that getting yourself registered as an LLC or a C Corp by 40% increase since January. So basically what that means is someone became unemployed, lost their job, and said, hey, I'm going to go form a company and I'm going to do whatever. This is usually the beginning of an awesome wave of great companies because they will either matriculate back to become employees because their company didn't work, or they're starting to rehire, or hopefully, and we've seen this pan out in the past during recessions, a large number of them will have gained some type of traction. And what I mean, guys, is that this can be any business. We were just talking before we came on about doing kind of like, hey, if I want to do a landscaping business, what does that look like, right? And that's a completely bootstrapped gig, right? I'm going to run around, I'm going to hit up some garage sales, I'm going to grab a lawnmower, I'm going to grab a weed eater, I'm going to hire some college kids, and then suddenly, we're pulling in $200K a year, and we got into the lawn care business. That is because, well, I lost my job at whatever company I did, and then necessity and desperation joined together during the pandemic, and then this happened. But the end result is, whoever that guy or gal is now literally probably making 2 to 3 times what they were at their company. This isn't about tech. It's not about, doing this, all the science stuff or any of that. It's really about what am I going to do next, right? And those that have kind of the entrepreneurial DNA seem to just immediately attract themselves during times like this to go start something cool. So, on that side of it, there has been, by the numbers, a dramatic increase in new formed companies. And I'm just, fingers crossed that, half of those stay around and kick ass.
For sure. I'll share one more change I've seen, which can sound obvious, but I've seen some founders not do it. If you are raising capital and you're presenting to angel investors or VCs, make sure you address what's going on today and how it has affected your business. We want to know. It can be good or bad, but we want to know how it has affected it, how you've responded to it. I think typically when we see a founder present and they don't really touch on where we're at today and how it's affected their business, it arises more questions and assumptions and makes the deal harder to get done. A lot of times we'll straight up ask about it, but a lot of times we might leave the meeting if we didn't get to it, scratching our heads, wondering, well, unsure how this has affected your business.
I think that also goes to the why of the business to begin with, right? So in front of angels, in front of VC, and in some cases, friends and family, to be honest, what's the story? What's the why that got you here? That's important, not only for those investors that may want to invest, but what's the story you're going to tell your customer, right? There's a reason this company exists today, and your customer wants to hear that story. Angels want to hear that story, and VCs want to hear that story. And if COVID brought you there, or COVID impacted you to create some pivot that said, hey, this happened during COVID, so we decided to go in this direction instead, and look at what happened. Look at these customers we're getting now. That's extremely compelling. And we definitely want to hear it, for sure.
Yep, for sure.
Hey, Dax, you got any questions? I see you over there.
A handful of people in here.
Or you, Crystal, I see you over there too. We can't actually see you, by the way. You can only see us. So drop some questions in here.
Yeah, we'll pause for a second. If you guys want to drop any questions in the chat, we'd love to hear them and I'd love to address them. We can go deeper on other topics, but we'll pause for a second to see if any guys, you guys or gals out there have questions.
Yeah, ask us anything startup. You have us trapped.
I'll say, I guess, while we have this pause, I'll share something about the fundraising versus bootstrapping. I see a lot of founders start with the fundraising mindset, and I think that's the wrong mindset. We have a question coming, we'll answer it in just a sec. I'll finish this thought and we'll take a look at that. I think you want to start with the bootstrapping mindset. End of the day, your company exists because you have customers that you're driving value to, not because you got some money from an investor. That's not why you should exist. That's no reason to exist. Some companies need venture capital or capital up front, which is fine, but there's a lot of companies, I'd say almost the majority, where you can start delivering value to your customer, even if it doesn't look like it's going to look in a year or 2 years or 3 months or 6 months. There's ways to start showing and driving value to your customer today, even though it might not look like the perfect version of your product, you can do it today. And that's very much a bootstrapper's mindset of driving value to the customer, getting paid for that value. But if you start with the fundraising mindset of, I just need some capital to build product X and then I'll make a bunch of money, I'll just share that today, that pitch is more and more challenging. The bar has actually gone up for early stage funding, where a lot of investors are looking for early metrics, early signals for traction, having some early customers.
So what Cole is saying is, in a nutshell, if I'm not mistaken here, Cole, get some customers, right? So if you have customers and then you're able to bring those customers to an angel or to VC, you are compelling, you are the story. They do want to invest in companies that are already making money, revenue, I should say. It doesn't quite necessarily have to be profit, but that you have customers. But that's kind of then where you sit in the decision-making process then. You sit in the decision-making process of then, should I just keep going with customers, or let me assess how much money I now need to raise, because that number is now changed. I may need to raise much less, and there's lots of great reasons to raise. You have equipment costs, you have sales costs, right? You have employee salaries, hires that you need to do. So there's great reasons to seek investment. But keep in mind that when you're raising money, you are also giving up a percentage of your company every time you're doing that, right? And then it becomes whether that founder is thinking to themselves, hey, how much control of this company do I want, right? If the way that you built this company was, hey, I know I can get this company to $10 million, right? But I've sold 8 million of it in equity out. Is this all going to be worth your time at that point? To be the CEO / founder who's working getting 20% and you've already sold out 80%. So you have to think about those choices as things are happening. So you have to be kind of sharp in this to decide where you stand during the process.
Yep, for sure. We got a question, Nick. So it says from Bernard. Thanks for asking, Bernard.
Hey, Bernard.
Do you think the lack of in-person collaboration is having a dramatic adverse effect on the startup community?
There's going to be some yes and no in here, Bernard. It's not even going to be me trying to make this politically correct answer. The answer to you directly is yes, but there's some caveats to this. Ultimately, we're just pausing, right? I have a lot of faith. Cole and I talk a lot about this. We have a lot of faith that when things come back, they're going to come roaring back. Now, what that looks like right now, is that a year from now? Is that a year and a half from now? Likely. But we have then, at least as founders, have tried to come up with what we want to do. And what I mean is, if you're in a pause right now because of employment or you're trying to look for something, this is the idea book time, right? This is the time to actually start generating new ideas and passing them to a couple of people that you can have conversations like this with, right? You can still do it this way. You can still reach out. You can ping on LinkedIn. You can ping on Facebook, and you can say, hey, let me throw this idea at you. So the face-to-face thing is definitely, for me, a yes, because I like to collaborate in person and to be involved. But there are still ways that you can express it. Hey, I got some ideas. This is what I've been working on. What do you think about this? And kind of pass it through your own personal network, or to anybody. Just reach out. I mean, I'm always surprised that if you ping somebody on LinkedIn or Facebook, they will answer you. I answer, Bernard, so if you want to hit me up on anything, I answer, and I'll tell you whether I think it's cool or if you're going in the right direction. But we're going to come out of it. We'll get somewhat back to what we're all talking, this new word, this new normal thing. And then I think just we're going to have a lot of great ideas on the table. And I think it'll be kind of an awesome, complete restart to everything. It just sucks that we have to sit and pause and not have all the interaction we're used to. So, I think we have to tough it out and keep our heads spinning, trying to come up with new stuff as much as we can.
Yeah, I think the environment's changed, but one thing I'll share I see with any community, our startup community or others, you really get what you get out what you put in. And so even being at Geekdown with a bunch of people around and you're not being proactive and getting in front of the right people or talking to the right people or collaborating, you don't get much value. So even today, there's still the community here at Geekdown. There's still the kind of members dashboard that you can find other members on, or reach out to other members who are part of the geeking community, or reach out to the staff to get connected to someone who can help you with the current challenge.
Where I see really good activity too is Facebook groups, Austin startups, San Antonio startups. I see, and any city, pick your poison. I see really good activity there. They'll ask a question and people will answer. Yep. And I think it's a great opportunity for people just to kind of use some of those tools that are in front of them and say, hey, I had this idea. If anybody's interested in working on it with me or looking at it, hit me up. I mean, there's, no shame in asking. Right. And then, you get some responses, but I've been seeing a lot more of that for sure.
Yep.
So, I'm taking a lot of these things as a good, not as a bad right now, personally.
For sure. And what we told all of our startups, not directly addressing this question, but I really see the times as different. And every time will be different. Next year will be different. 2 years from now will be different. As a business or founder, you always got to be adapting to whatever's going on at any given time. And I consider these times, though drastically different, it's different, and you gotta react and adapt. And so, really, it's about keeping your mind open, looking for the opportunities, given the current situation. You don't want to get stuck in thinking what you did before will always work forever. I think it applies here too.
Well, to piggyback off of that, we've actually talked about this. The question is, in a bigger context, is what did COVID do? And I think COVID just fast forwarded what was already going to happen. So curbside, delivery, video conferencing. I think we can come up with a few more. Those things were already going to happen. So what happened is this thing interjected itself in the last 7-8 months of our lives and accelerated the things that were already on the back burner that got brought forward. So some of those things are going to thrive and still do well when COVID finally disappears into the back. But I think things like curbside and delivery are here to stay. I think last mile delivery stuff is here to stay, which is a good thing because it was going to happen anyway. So those that were already working on those things, those people that were already might have had a handful of customers are thriving today because of those things. And sure, they may get knocked down a little bit as this dissipates, but a lot of them are going to stay rocking and rolling.
Yep.
I was already using DoorDash is what I'm saying. I was already using DoorDash. Now I use DoorDash 4 times as much, right? So when this all ends, I'll still be using it twice as much. So.
For sure. So we have another question that came in from the Wollak platform. So thanks to whoever asked this one. It is, what's the first thing startups should do when they start thinking about investment? I'll share a quick thought, and then if you want to share, we can go back and forth on this one. My first thought would be, ask yourself why you want to fundraise. And make sure you have a good answer for that. If it's just because other people are doing it, that's a bad answer. Really ask yourself, why am I raising this capital? You're giving up some of your business. You're giving up a portion of ownership in your business to these investors. But it needs to have some major impact and reason behind why you're raising capital. A lot of times I see founders going out to raise capital, and sometimes it just feels like it's the answer is because other people are raising capital, because I see other startups do it, because I saw the startup raise $1 million. Those are not good answers. You should know what is the impact to your business and the future for your business if you're thinking about raising capital. Not suggesting whoever asked this question is in that state, but I do think it's something that a lot of founders will skip, really deeply thinking about why am I going to raise capital?
I also think, right in that same train of thought, that your why for those things is really relates to the why of the whole company as well. Don't go into that where you don't have your stuff really kind of your ducks in a row, right? When you go to a VC or an angel, having those line items specific to, I need to raise money because I need to hire 2 salespeople because of this reason. I need to pay for this networking equipment because of this reason, will increase your chances of getting funding outside of your own bootstrap because they're clear reasons. Don't say, because I'm going to pay myself and I sure do have a lot of development work I have to pay for that I'm outsourcing, right? Because those become, an investor is not in the business of employing you as a person. They're investing in the company as a whole, and they actually want to see why you need this money, not just to pay myself and to build something that I haven't even tried to build yet. And that leads us to having an MVP, right? Having something that I can put out on the market and get 1 sale from, get a couple of sales from. And that is a hugely important milestone, even for a bootstrapper, guys. So you build something, borderline frameworky almost. I'm saying this thing, it doesn't have to work great, doesn't have to have all the features, but does get to the main selling point of what you're doing. And you prove that model works, that's a game changer, right? It's not a game changer to come in and say, I have no software, or I have no whatever, go back to that lawn mowing one, no equipment. Can I mow your lawn, right? Or can I do this? And the answer is no. Versus, hey, I already have all this. This is my equipment, or these are my customers for my MVP of my software. Will you give me money? They'll be like, wow, you already have customers. Yeah. And we have a lot to do. More likely you're going to be able to raise money from that.
Yeah, definitely. That is a pro tip, which is hustling and showing you can make progress on zero or bootstrap capital will dramatically increase your odds of getting funding or financing if you show in some early hustle with no capital.
Absolutely. Oh, you got another question.
Cool, another question coming in. I guess I'll share really quickly, though, tactically, if you want to hear a little bit more tactically to answer that question, pitch deck is a great place to start. There's a bunch of templates, examples online that you can start with. Just start with those, fill it out, because you're building a story in your pitch. They generally follow almost the exact same pattern, so anyone you find should be good enough. And just start there, and then go pitch it to a mentor or a potential investor and see how it lands. Pitching and pitch deck and going up for investment, I see as a very iterative process. It's not a one-time it's done. You're always going to be listening for the feedback from the mentors or investors that you connect with. Don't think you'll just build a pitch deck, go pitch it, and get funding. It's a very iterative process. It's not a one-time done thing.
Yeah, that's for sure. Yeah. Also, when a pivot happens, because it can happen in the middle of your deck.
Yep. Because
you're out there trying to get actual customers, or you're building an MVP, and then you realize, wait, there's no customer for this, but I still have this nugget over here that's actually selling. So then I have to revert back, change the deck, and maybe even change who I'm going after as an investor. So a lot of things, a lot of dynamics are changing. So you can't, I always call it marrying your idea, right? So you can't marry your idea. You have to be flexible through the whole process, whether it's bootstrapping, funding, or building the product to begin with. Don't ever marry where you're at. Trust me, it's gonna backfire, because then you're basically just kind of pushing off anything new that could be happening. And I'd rather things be happening so then I can react to that in a way that's, attractive to a customer and then attractive to an investor.
Yep. Cool. Well, looks like we have another question come in. It says, Ramon, thanks for asking this question. When raising capital, people tend to tell me to move out of San Antonio to cities with more capital available in the startup ecosystem or the biotech field. I see that as an opportunity to grow San Antonio, but I also see it as a sign to get out. What are your thoughts on it? I'll share from a venture standpoint, because it might be different than a lot of other mindsets. From a venture standpoint, a lot of times venture wants you to be wherever is best for your company. So if you're pitching to a venture capitalist, I wouldn't be surprised if you're hearing that. They really want you to be optimized for their returns, for them to make the most money off your business and growth. And if being in a different city puts you in a better spot for that, that might be part of their criteria. There's some funds, some groups, some investors who really care about playing the home game, I'll call it, which is backing founders and startups in the cities that they're in. And so part of that is trying to find who are those investors. A lot of times I'll share generally they're angel investors who are supporting that. But I'll also share there is a growing trend of VCs investing outside these major hubs, or I'll say the coast, East Coast and West Coast, actually being a part of their thesis today that they're looking for money to deploy outside of the coast. And so maybe seek out some of those funds that are more proactive in investing in the kind of central US rather than just the coast. I also see more and more every day. I'm not there, so I don't know the feel for it, but I get this feel more and more every day of a lot of companies on these coasts actually looking to move off of the coast and into these more,
it's the flyover cities.
US, the flyover cities. So I'd say yes, it's definitely a challenge. I think part of it is a decision for you as a founder as well to know what matters to you. Like Nick said, know your why. And if part of your why is tied to a location, I wouldn't give up on that. I'd really, stick to your guns and find the funds that are open to backing founders in these flyover states. I know one, for example, is called Rise of the Rest, I think run by Steve Case. that actually their thesis is investing in flyover city founders.
Yeah, that's rise of the rest, buddy. It's funny, Cole, that you say that, because I always find that if an idea or product more so, is compelling enough, you can almost put it out anywhere and you're going to start getting some feelers, right? If I'm going out to raise money, something specific or not, I'm going to be looking for specific funds that handle biotech in his case. And biotech, I don't particularly care what city it's from, right? And looking for the caveats. Wait, does this mean I have to move to your city? Is a different answer. And am I willing to do that? That is another thing. But if you take biotech funds and say, look, I have a group of 10 biotech funds, I'm going to go and pitch them and see who you get responses from. It's telling about the product, and it's telling about whether they're central to their location or not. I think less and less are central to their location today. They're looking for great deals that they can make money from, guys, to be honest with you. VCs and angels like returns on their investment. That's different than, bootstrappers and, MasterCard. They don't care that much. But they're looking for investments that return. And if something is compelling enough, it'll draw their attention.
Yeah, exactly. There's a great success story of that right here in San Antonio with Rackspace. When they went out to raise a venture round, I don't know if it was their first one or the second one, but they had multiple term sheets, I think maybe up to 20 or so. I don't know the exact number, but a ton of term sheets. There's a lot of interest. So like Nick said, create a product and business or company that can get that interest. But the one they chose was the only firm that was willing to say you can stay in San Antonio. They stuck it out. None of the term sheets actually had it in it. They circled back to talk to all the funds that were there and said, are you open to us staying in San Antonio? A bunch said no, one said yes, and they made a fantastic investment.
Yeah, cool.
Let's see. So a comment from the San Antonio Startup Week, Ramon, yeah, check it out. I guess the next session is actually on the entrepreneurial support and ecosystem here for biomed and biotech. So that should be an awesome one.
And there's actually a thriving community around biotech, especially with Velocity TX.
Yep, Velocity Texas, their new space. I heard they have some really interesting developments going on. I can't spill the beans on it. I don't know if it's public yet, but they have some really, really cool stuff going on in their new space. And so definitely worth connecting with them. I'm sure you've connected with them, but maybe worth connecting again because there's some new stuff brewing, which is super exciting.
Yep, for sure.
Cool. We're pretty much coming up on time. I guess maybe, Nick, we want to share some closing thoughts. Drop in any last questions if you guys have.
Yeah, we have time.
We have about 8 minutes left, but feels like we're coming up on wrapping this up. So,
Gabrielle, do you have any questions? Larry? You gonna type the word nope? No, I'm just kidding. Don't type the word. There we go.
What's next for both of us and things like that? Yeah. So Nick is here helping out with RealCo, helping me out with RealCo. RealCo is doing awesome. We get, just to share kind of where we're at, we get about 10 applicants a week that we're reviewing every week. We highly encourage anyone watching the stream that thinks RealCo might be a fit for them to come apply. www.realco.com, as you can find us, and there'll be a bunch of call to actions for apply now. Click on that. Our application takes about 3 minutes. If it's really not a fit, we'll follow up within 24 to 48 hours and just say, hey, it's not a fit for this reason. If it is a fit, we're going to reach out to say, hey, let's hop on a call to dig a bit deeper. We want to learn a little bit more about each other, see if it'll work for us working together. So we have some exciting stuff in the pipeline. I can't share it yet because they're not officially closed, but we're super excited about a couple of companies that we're talking to right now.
Yeah. And to add to that a little bit, I've been helping Cole with RealCo over the past few months. Definitely COVID response for me, because I wanted to engage with startups and entrepreneurs at some level where I knew that I could, or try to be as helpful as I could. So I wasn't just sitting at home and This is just an awesome way to still talk to startups, to see what they're working on. And so it's been an awesome learning experience for sure. And it's been just really cool seeing some of the teams that come across and talking to them, you know, with Zoom and asking questions and kind of following the process a lot like you guys follow the process. It is really, really interesting to see. So I don't know, I guess we'll see from here. I just want to watch Cole land a couple of big companies. That's what I'm in for right now.
Working on it. Larry, yes, for sure. You can email us, cole@realco.com, nick@realco.com. Feel free to reach out to either or both of us. Same goes for everybody out there. We're happy to help if we can. And you know, our main goal is just finding companies that are fit for RealCo and those companies that want to work with us at RealCo. We have a long-term acceleration program that's backed by a guarantee that you reach 500K in revenue. So really putting our money where our mouth is and backing founders that we think can reach that level. And so happy to talk to anyone who thinks they're in that bucket, and I would love to hear from you. I guess to wrap it up, I'll just share fundraising is super hard. It's really, really hard to get funding. It's really, really hard to get customers. So both paths are really, really hard. I'd share don't give up, but be honest with yourself. I've seen some founders fundraising for a year or more with very little to no traction. Just be honest with yourself. Is the market telling you something? Maybe what you're working on isn't the thing. Maybe you need to pivot. Maybe you need to work on something else. Maybe there's a gap, be it on the team, the technology, who knows what. But don't fool yourself. It's really hard to do this, but don't get discouraged. But at the same time, you got to hold some level of intellectual honesty with where you're at and where you thought you would be, and always checking in with yourself. Geekdom's a great space to get access to mentors. I highly encourage you to, if you're not already, become a member of Geekdom and get access to the resources and mentorship that they offer. So
all you have to do is ask, honestly. Oh, wait. Okay, you already answered that for Larry. So yeah, you can absolutely email us. And that's what I was going to too with the don't marry your idea. I mean, honestly, the intellectual honesty thing is the most important thing you can do as a founder. Whether you're raising, whether you're bootstrapping or not, is don't fool yourself. Ultimately, customers will tell you their story, which is I'm not buying your product, or I am buying your product, okay? And then you can actually go from there, which means how do I accelerate customers? So how do I add fuel to that fire? And does that require me to either accept some type of funding to be able to do that through sales, or do I continue with just bootstrapping and getting more customers and doing my own marketing and doing all of those things? But it really does come down to, do I have customers, and am I willing to put in the amount of time it's going to take, right? Because it takes a lot of time.
it does indeed. So we'll wrap it up there. It's 1:47. So y'all are welcome to leave now. It's not going to hurt our feelings. We'll hang out just for the next kind of 2 to 3 minutes if anyone jumps in with any final questions. But otherwise, just want to thank everyone for joining. Our one ask really would be, if you know a founder who you think might be a fit for RealCo, please encourage them to apply. We would love to talk to them.
Yep, for sure.
But anyways, thanks everyone for joining. Really appreciate it.
Thanks, guys. If you need anything, holler at us.